When the Federal Reserve's quiet signal rippled through the market, JPMorgan's carefully laid global blueprint shattered in minutes. In a flash, the bank's $58.5 billion profit announcement for 2024, the highest ever, was eclipsed by a 3% plunge in its share price, 30% leaving analysts scrambling for explanations. The headline reads, U.S. shakes JP Morgan's global blueprint. Wall Street is quietly panicking. But what does this mean for the world that relies on the bank's $2.7 trillion asset and wealth management engine? The intrigue lies in the paradox. Record earnings, yet a market that refuses to reward the news. Economists point to a hidden lever, a sudden shift in the Fed's tone that signaled a longer than expected high-rate environment. That whisper altered the discount rate applied to JP Morgan's future cash flows, instantly eroding the valuation that investors had baked into the stock. In behavioral terms, the market exhibited a classic Moss anchoring bias, clinging to the expectation of rate cuts that never arrived, and reacting sharply when reality diverged. A nudge forward comes from an unexpected source. JP Morgan's own earnings release showed a 49% surge in investment banking fees and a 21% rise in trading revenue, yet the stock fell. The mechanism? A subtle repricing of risk across the entire financial system, triggered by a single line in the Fed's minutes about maintaining a restrictive stance. That line rippled through algorithmic trading desks, forcing a rapid reallocation of capital away from high-duration assets, the very assets that underpin JP Morgan's balance sheet. Why should a regular investor care? For the average household, the bank's fortunes ripple through 401k plans, mortgage rates, and even the cost of everyday credit. When a titan stumbles, the cost of borrowing climbs, and the value of retirement portfolios can shrink by hundreds of billions of dollars in a single trading session. Moreover, the psychological impact of watching a safe haven stock wither away can trigger a loss aversion cascade, prompting investors to pull back from riskier assets, a move that can depress broader markets. Visuals for this segment should pair a live ticker of JP Morgan's price drop with a heat map of global equity markets turning red, while a subtle overlay of the Fed's minutes highlights the key phrase. A graphic of the bank's $2.7 trillion asset base anchors the narrative, reminding viewers that size does not guarantee immunity from market sentiment. But here's the part nobody expected. While Wall Street is busy decoding the Fed's whisper, a deeper structural shift is already unfolding in the shadows of the global payment network, and it could rewrite the rules of finance as we know them. But the real shockwave isn't the stock tick. It's the silent recalibration of power inside the bank's own ecosystem. In the hours after the earnings call, senior traders reported a sudden surge in hedge adjustment orders, a move that rippled through the interbank market like a phantom. This is the intrigue. A single institution, armed with $94 billion in projected net interest income for 2025, is now forced to reprice its entire risk profile overnight. The hidden mechanism lies in the bank's massive derivatives book, which, according to the latest filing, contains over $300 trillion notional exposure. When the Fed hinted at a prolonged high-rate regime, the valuation models for those contracts flipped, instantly widening spreads on credit default swaps and pushing collateral calls into the billions. In psychological terms, the traders experienced an availability heuristic. They overestimated the likelihood of further rate hikes because the recent Fed minutes were fresh in their minds, leading to a cascade of defensive positioning. A surprising nudge forward emerges from the bank's own technology division. JP Morgan's blockchain-based payment platform, JPM saw a 27% spike in transaction volume within the same 24-hour window. The surge wasn't driven by retail users, but by institutional clients seeking to settle cross-border trades faster amid the rising margin requirements. This unexpected correlation suggests that the bank's digital infrastructure is becoming a safety net, a hidden lever that could either cushion or amplify the shock depending on how it's leveraged. Why does this matter to you? For the everyday consumer, the tightening of credit lines and the higher cost of borrowing are felt immediately. A $5,000 car loan could rise by $200 per year. For small businesses, the sudden increase in collateral demands could stall expansion plans, freezing hiring and slowing economic growth. Moreover, the psychological comfort of a digital payment rail that operates 24/7 offers a glimpse of a future where traditional banking hours no longer dictate the flow of money, reshaping expectations of stability. Visuals should juxtapose the $300 trillion derivatives exposure with a simplified diagram of the Fed's rate path forecast, while a live feed of JPM coin transaction volume runs alongside. A short, unscripted interview clip with a senior risk manager, voice masked, underscores the urgency. "We've never seen margin calls this fast. The system is testing its own limits." This visual contrast highlights how traditional leverage meets emerging digital rails, a theme that will echo throughout the report. But here's the part nobody expected. While analysts dissect the derivatives numbers, a quiet team inside the bank is already testing a new AI-driven liquidity model that could bypass traditional market makers altogether, potentially rendering the current shock obsolete. It gets deeper when you look beyond the ticker and see the world's reaction to JP Morgan's turmoil. In London, the FTSE 100 slipped 1.2% as European banks braced for a domino effect, while Tokyo's Nikkei edged lower, citing the same Fed whisper that unsettled New York. The intrigue here is not just a US story, it's a global synchronicity that reveals how tightly interwoven financial hubs have become. The deeper question is why markets across continents mirrored each other so precisely. The answer lies in the shared reliance on the dollar-denominated funding system and the universal application of the Fed's monetary policy as a benchmark. When the US central bank signals a shift, every institution that holds dollar assets, from the European Investment Bank to the Asian Development Bank, must revalue their portfolios. This creates a psychological echo chamber, where the herd mentality of institutional investors amplifies the initial move, turning a single data point into a worldwide market tremor. A surprising nudge forward comes from a historical parallel, the 2008 credit crunch, when a similar ripple began with a single mortgage-backed security and spread to global balance sheets within days. Today, the catalyst is not subprime loans, but a subtle change in rate expectations. Yet the mechanism is the same, a rapid repricing of risk that forces a massive, coordinated deleveraging. The difference now is the speed of information flow. Algorithmic trading platforms execute millions of orders in milliseconds, compressing what used to be weeks of adjustment into a single trading session. Why should a farmer in the Midwest or a shop owner in Nairobi care? The answer lies in the behavioral economics of scarcity. When global credit tightens, commodity prices, from wheat to copper, tend to fall, reducing export revenues for producers and tightening margins for small businesses that rely on imported goods. Simultaneously, the higher cost of capital discourages new investment, slowing job creation worldwide. The psychological impact of watching markets tumble can also trigger a negativity bias in consumers, making them more cautious with spending, which further dampens economic activity. It gets deeper. As we peel back the layers, it becomes clear that the real story isn't just about a single bank's earnings, but about a systemic shift where digital payment rails, algorithmic risk models, and global dollar liquidity intersect. The next segment will show how this perfect storm is already reshaping the daily financial decisions of millions, and why ignoring it could mean missing the most significant transformation since the rise of the internet. A final visual will overlay a timeline of the 2008 crisis alongside today's events, emphasizing the speed and scale of modern market movements. Because while the headlines scream about a bank's profit surge, the quiet crisis unfolding in the back office is far more consequential for your wallet. In the past month, JP Morgan's technology chief announced that AI tools will eliminate up to 15% of routine analyst positions over the next 3 years, a move that could cut 30,000 jobs worldwide. This is the banger. A financial titan is preparing to automate its way to higher efficiency, and the human cost is being whispered about in conference rooms, not on the news. The intrigue lies in the paradox of a bank that just reported record earnings also planning to shrink its workforce. The hidden lever is the same AI that powers JP Morgan's trading algorithms, now being repurposed to handle compliance checks, risk assessments, and even client onboarding. By automating these tasks, the bank expects to save $2 billion annually, but the psychological impact on remaining employees is a growing sense of job insecurity that can erode productivity and innovation. A surprising nudge forward comes from an unexpected source: the bank's own community outreach program. In partnership with local nonprofits, JPMorgan has launched a free financial literacy platform that uses the same AI to personalize budgeting advice for underserved populations. While the platform is a public good initiative, it also serves as a testbed for scaling AI tools that could eventually replace human advisors across the entire organization. Why does this matter to you? For the average household, the shift means fewer high-paying jobs in finance, but also the possibility of cheaper, AI-driven financial services. For a recent graduate, it signals a job market where technical skills are prized over rote analysis, prompting a re-evaluation of education and career paths. The broader economy feels the ripple. As finance jobs disappear, there is a modest but measurable shift toward tech and services sectors, a trend that could reshape urban landscapes and tax revenues. The media isn't discussing the deeper ethical dilemma. As AI takes over core banking functions, who owns the data, and how do we ensure that the benefits of automation don't accrue solely to shareholders? This question is being debated in boardrooms, but it rarely reaches the public discourse. Visuals for this closing segment should feature a split screen. On the left, a bustling trading floor with flashing numbers. On the right, a quiet office where an AI interface calmly processes data. A subtle pulse graphic underscores the heartbeat of change, reminding viewers that the future of finance is being written in code, not just in ledgers. Because while everyone is focused on this, the real transformation is already unfolding, quietly, and in a place no one expects.